Up next, Goldman's Jeff Currie called for a commodity supercycle on our air yesterday, and he's not the only one seeing strength ahead. RBC also expecting higher prices, and there's one name it says is more stable and attractive than its peers. We'll tell you it next. Welcome back to the exchange. Chevron moving higher after RBC Capital Markets upgraded the oil major from sector perform to outperform and raised its price target to $145. RBC believes the company will benefit from a strong commodity cycle in coming years and say they have a more stable portfolio than peers. Shares up nearly 1% today, trading around 117. And joining me now is the analyst behind this call, Borkhataria. He's the co-head of European Energy Research at RBC European Energy Research. Baraj, welcome to the program.
All right, thanks for having me.
Tell me why Chevron is more attractive, has a more attractive, more stable business model, you think, than some of its peers.
Yeah, it's really the two factors you touched on. So the first one is that we do believe as a house we're in the early stages of a prolonged commodity bull cycle. And despite Chevron's safe haven status in the sector through the downturn, it actually has a lot of leverage to oil and commodities in general. I think that is underappreciated. And the second one is the visibility on free cash flow. So you have many of their international peers looking to transition to low carbon assets, and they're selling their hydrocarbon assets to fund that. When you look at Chevron's energy transition targets, they imply a relatively stable business mix over the next decade. So ultimately, we think there's greater visibility on that free cash flow stream, and that should command a premium multiple relative to peers.
When I speak to a lot of energy investors these days, the reasons they don't like Exxon and Chevron are because of this diversified business model. They'd rather have pure play exposure and, frankly, because of the headline risk, the divestment pressures, and so forth.
I think those pressures will continue to exist. I think those can wax and wane over time, depending on where commodity prices are. I do think as we move through the winter, and the consumer starts to feel the brunt of higher commodity prices, whether it's food prices or fuel or heating, I think those concerns may go the other way, and we might be talking about energy security in 2022 versus emissions necessarily.
Shepard Smith here. Thanks for watching CNBC on YouTube.